Continuing with analyzing business transactions, if you refer to page 37 in your textbook, it talks about 5 steps that you need to follow. The first step is you need to decide which accounts are going to be involved. Second, you need to be able to classify those accounts, and by that I mean you need to determine whether those are asset accounts, liability accounts, owner's equity, revenue, or expenses. You then need to decide which accounts that are involved are going to be increased and which ones are going to be decreased. Step 4, you then need to decide which accounts are going to be debited and which accounts are going to be credited. And finally, you need to check to make sure that your equation is in balance after the transaction has been recorded. You need to remember that for every transaction, you must always have debits that are equal to credits. Some of the transactions that are in Chapter 2, we're going to look at and analyze into their debit and credit parts. If you refer to page 44 in your textbook, it will show you the summary of these transactions. The first transaction that's listed in your textbook says, Mr. Cruz deposited $70,000 cash in a bank account in the name of the business. If we look at the steps in analyzing transactions, the first step says you need to determine what accounts are going to be affected. The accounts that are going to be affected is the cash account, which is an asset account, and the Cruz capital account, which is owner's equity. The next thing you need to do is decide of those accounts which ones are increased and which ones are decreased. If you are receiving cash, you are increasing your cash, and the owner is investing more money in the business, so he is increasing his owner's equity. If you look at the cash account, you need to determine whether the cash account is going to be increased or decreased. We are increasing our cash account by $70,000, so we're going to enter the $70,000 on the debit side of cash. The owner's capital account is also being increased. Capital increases on the credit side or the right-hand side, so we're going to put the $70,000 on the right-hand side of the capital account. We said that each transaction has to have one debit and one credit. So we are debiting the cash and we are crediting the capital. In this particular example, both of those accounts are being increased, but one increases on the left-hand side and one increases on the right-hand side. Another example of a transaction that's listed in your textbook is Cruz Auto Detailing buys equipment paying $43,000 in cash. Following the steps of analysis, the accounts that are going to be affected are equipment and cash. Both of those accounts are assets. We are paying out cash, so we are decreasing the cash, and we are buying equipment, so we are increasing our equipment. If we look at the equipment account, to increase equipment, we need to show the $43,000 on the debit side of that account. And we are decreasing the cash. We look at the cash account, a decrease is indicated on the right-hand side or the credit side. Proving that our transaction is in balance, we have a debit to equipment and a credit to cash. Another example. Cruz Detailing buys supplies on account. On account, it means that they are charging, and they will pay for those supplies at a later date. The two accounts that are affected, supplies, which is an asset account, and accounts payable, which is a liability account. If you are buying supplies, you are increasing your supplies. So in the supplies account, since it is an asset, it increases on the debit side. We are buying $800 worth of supplies, so we are going to debit the supplies account. Accounts payable, which is a liability, is being increased because we owe more money to our creditors now than we did before. So to increase a liability, we have to show the amount on the right-hand side. We have a debit to supplies and a credit to accounts payable. Another transaction that's listed in the text is Auto Cruise Detailing sold services for cash. Services is revenue or sales. The two accounts then involved in that transaction are cash and sales. If we are selling our services, we are increasing our sales. Sales is a revenue account. Revenue accounts increase on the credit side. We are selling $3,520 in sales, so we're increasing our sales on the credit side, and we are receiving cash, so we are increasing our cash, $3,520 on the debit side of the cash account. One debit, one credit. Another transaction would be Cruise Auto Detailing paid rent for the month in the amount of $900. Rent is an expense. We said that expenses increase on the debit side. So if you are paying out $900 in rent, you are increasing the amount of rent that you have paid for the year. So to record that, we would show the $900 on the debit side of the rent expense as an increase to rent, and we are paying out cash, so we are recording that on the minus side or the credit side of the cash account. Again, we have one debit and one credit.